Hello and welcome to Pro Trader Strategies market commentary for Friday, September the 11th. Yes, it is September 11th. Very sad day. I traded through it in 2001. I was there on the floor while it was all happening in real time. So today is a very sad day, but without further ado, let's get on with it. My name's Eric Wilkinson. You may very well recognize me from mainstream media where I've talked about the economic data, the geopolitical environment, how that comes in to impact the overall markets with my market analysis. And I'm going to do the same thing for you guys in these daily market commentaries, but I'm going to layer on it some option strategies I'm putting into my portfolio based on these assumptions we come up with that market analysis. And without further ado, let's get on with the economic data. Today we got the CPI numbers, which is kind of reflective of what we would see in the PPI numbers. Remember, PPI is Producer Price Index. CPI is Consumer Price Index. Well, we saw PPI uptick a little bit. Well, that means producers are paying more for those inputs. Well, are they passing that on to the consumer where we would see more inflation? And they are able to pass it on, it seems, as we get core CPI stripping out that food and energy, coming in at 0.4%, expected to be 0.2%, and core regular CPI, when you put back in that food and energy, came in at 0.4%, expected to be 0.3%. So the companies are able to pass on their higher prices that they have to pay on to the consumer. So that's generally speaking a good thing. It shows inflation, shows some demand from the consumer. If you start seeing those corporations have to pay more for the inputs and not able to pass it on to the consumer, that usually is a little bit of a drag on the economy there, because then the corporations aren't able to make money, right? And not able to hire and things of that nature. It starts eating into their margins. So obviously they're able to pass that on to the consumer. Now let's talk about crude oil. Moving just slightly higher. Still, it's kind of getting really comfortable right here at this $37 a barrel area. I like to see it in the 30s. You know, you've heard me talk about this time and time again. I'd like to see it hang out there, as that would allow the consumer. I don't like to see higher prices, right? You and I would like to rather be able to see lower prices, to be quite honest, because then you can spend your money in different areas. And especially right now, that is really important, as there's a lot of businesses struggling. And if we have that extra money in our wallet, then we're able to spend that in different areas of the economy. And that creates velocity of money, which will really help us, especially during this pandemic, or coming out of the pandemic anyway. That will help speed up this economy, give it a shot in the arm, if you will. All right, gold is pretty much unchanged. It feels like it anyway. Hanging out above that Fibonacci we've talked about. Is it going to test that 2,000 again? It just doesn't seem like it has that momentum to get up there and stay above 2,000 for any sustainable time. So it seems like it's going to want to start trading in the 1900s, back and forth, and testing the 1900 even, which would go below that 1923 area, which is a major support line, and then kind of bouncing up, losing a little steam at 2000. Now really the determining factor is going to be whether or not we get another stimulus package, which is still up in the air. So we start seeing that become more of a sure thing, then we're going to probably see gold get a bit of a boost to the upside. All right, bonds trying to get above that Fibonacci right there. Really, we should be looking at the 177 handle, and it's just not able to do that. We bounced up against it basically yesterday. We are above, and did settle above yesterday, the 9-day simple moving average, but it's just finding some resistance on this 176.29, which is really, 32 ticks is a full point in the bond. So we're just slightly shy of that. I think we're going to get up there. It needs to get a little bit of momentum. We got a mixed bag in the equities, so the bonds are kind of trying to figure out what they want to do. And it seems like there's a bit of a sector rotation going on from the tech sector into some of the blue chip stocks, which we'll talk about here shortly. But the VIX coming off by about 2 points, broke out of those 30s yesterday, and we're kind of stuck in and around that area right now. Now, this is where I'm talking about a bit of a sector rotation. We'll have to see if the NASDAQ has moved into positive territory at this point, but earlier on it wasn't. We're up 160 points in the Dow Jones Industrial Average, and the NASDAQ still in negative territory here. And as a matter of fact, it's starting to migrate back towards the lows of the day. Down 44 points and testing that 50-day simple moving average. We can see here is tracking almost lockstep with my trend channel there, which isn't completely unexpected, to be honest, the way it's really trended nicely to the upside. I mean, almost feeling like a parabolic move and getting that correction, which I think is healthy. Now, are we going to come back down to 1029.50 or 10,250, or are we going to blast off towards the upside? Well, if we get that stimulus, I have a pretty good feeling that that's probably going to happen. But at this point right now, it's just seeing a lot of weakness. And I think that's mostly that sector rotation where people are seeing that these tech stocks have had a great move. They're getting a little frothy and overvalued, and I've talked about that for probably a couple of weeks now. And that I thought that we would start seeing a sector rotation into some of these blue chips, and that's starting to be what is happening right now as people are taking some of their money off the table in the tech sector and reallocating that money. Because remember, when this tech sector and all of this has happened, if you invested equally and had a diversified portfolio going into the pandemic, or at the during this pandemic, you created that diversified portfolio. Well, you've seen a lot of your tech, the FANG stocks especially, really outpace the broader markets. Now, that means you're overweight in those sectors there. So you do need to take some money, or you should be diligent and take some of that money out and allocate it towards some of those blue chips that haven't made that move, re-diversifying your portfolio and taking some of the house money off the table, really. All right, so we've got the NASDAQ continuing to slide there. E-mini S&Ps have been able to move back into positive territory, and as you can see, above the 50-day simple moving average here. And, there's a lot of S&P stocks that haven't really participated in this upside, so not really surprising that we're seeing some push here to the upside in the E-mini S&Ps. All right, breakdown of this market. Yesterday, despite the fact that we had a big move, it didn't break out as an outside day until almost the last minute of the day, and kind of broke this area there. But at the end of the day, we are trading pretty sideways, pretty quiet. I don't think that we're going to really see any massive moves today. It just seems like people are kind of sitting on the sidelines, and probably, despite the fact that we are past Labor Day and the rush to the Hamptons, people have already closed up their shop. A lot of people are probably trying to get out of the house and onto the road for the weekend, as one last kicker. So the market is just feeling very quiet. Feels like the volumes are really sloughing off. As you can see, volumes down here really lower than on any other day. So it just is being very quiet at this point, as people are kind of just jockeying a little bit here and there, but for the most part, just not a whole lot of momentum, not a lot of data to go off of, nothing really surprising going on. So it seems like the market's just kind of pretty humdum today. All right, so let's talk about humdum trades. No, I'm kidding. Well, I talked about this trade yesterday in the webinar, and it's great for this type of moment, if you will. We've kind of traded back and forth. Where are we going to go? And I talked about this earlier on when we were looking at the stocks. I don't really know right now. It feels like, we are getting this sector rotation, which could cause, the markets to be a mixed bag, the NASDAQ down, Dow up on any given day. Well, I do believe that we're kind of winding up for a move here. And where are we going to go? If we get a vaccine, the market could really spike to the upside, or we could do a little bit of pain trade, where that is where the market really tries to hurt some people that have weak hands. And we've talked about this old parabolic move that Wall Street really hasn't participated a whole lot in. And we're talking about they're calling them the Robin Hood traders, which they aren't all Robin Hood traders, but the newer investor has come in and started buying stocks on this way up. Now, since they're newer to trading, once they start seeing their P&Ls go down, they'll have a tendency to start folding their hands rather couckly, and we could see some corrections happen, some 1,000-point moves here in the Dow, and couple 500-point moves in the NASDAQ or whatever. But what I'm saying there, which way do we go? We don't always have to have a directional assumption. We just believe that, either the shoes drop or we're ready to pop, right? And that's kind of where I am right now. So I decided to go in there and put on a trade based on that type of market action where, is the market going to pop or is it going to drop? Well, we have really low implied volatility for the Dow Jones Industrial Average. So that leads us down the road of wanting to buy premium, right? Because when it's low volatility, those are option components or Greek components that determine the option pricing. And it's probably one of the major points of a shorter term trade on how that drives that pricing. So I decided I'm leaning towards buying. I don't know where it's going to go. I don't think it's going to stay right here, though. So that's major to this assumption. And so I decided to go in and buy a strangle. So I went into the November. It's about 70 days to expiration. So I'm getting outside of that theta curve that starts really ramping up inside of 35 days. So I want to stay away from theta. So I'm getting out on the timeline and went into the November and bought the 260 puts in there and bought the 292 calls in there for a total credit or total debit. I have to pay for those when you're buying options, right? So I paid $12.65 for that trade. Now, I'm looking for this to break out. I talked about the rules for getting in and getting out in that webinar. I don't have a whole lot of time to go into all of the details, but I'm going to follow those rules so you guys can follow along with me. I'll stay mechanical with it. I'm kind of looking at it if I start losing about 50% of that, so if it starts getting down to around $6 there, then I'm going to probably look to pull the ripcord on this trade. But if I can increase that by about 50%, I'm going to cover that there too. So looking at a couple of things there for that, and that's about it. Oh, one thing I wanted to talk about is PENN. It's a good time to do those covered calls. We're going down to cover that gap. Those PENN covered calls worked out nicely. That was the right timing for that. And, this is a perfect chart setup on candlesticks where you get that blow off the top candles, and today getting that confirmation. So it looks like we're probably going to migrate back down towards $55 in PENN, and I'll be able to cover those calls for hopefully pennies on the dollar. That would lower my overall cost basis on this trade by over $1, because I paid for PENN, I paid $4.49 for it, and then on those calls that I did yesterday, I collected $1.30. So if I can cover those for less than $1, then I've lowered my overall cost basis on PENN National to $3.49. That being said, $3.49. Look at that low. That low, or maybe I should go like that. The low, I think it's that way. The low there is $3.75. So I would have synthetically will have synthetically lowered my overall cost basis to lower than where you could have got in back in March. So just a little bit of fodder on staying mechanical with these types of trades. And if it blows off to 85, where I'm short those 85 calls in there, I'd be happy to cover this trade for that much of a profit, to be quite honest. That would be that would go down in history as the all-time best bottom picking trade I've probably had. All right, so that's all I got for you guys. One last thing, make sure you go over this disclaimer. Know the risks of trading options and or just trading in general by reading over this. So please take a moment to know what your risks are involved when we're doing this type of trading. It will increase your overall yield, but you know, there are some risks. So take a moment to take that into consideration. Also, have a great weekend. And if you can't take that, take it easy.